Welcome to Central Bank Central. I'm Kathleen Hays. Tomorrow, the Federal Reserve starts its two-day meeting and, of course, is widely expected to deliver its third rate cut of 2025. This is members of the FOMC, the Federal Open Market Committee, are split on the need to cut rates to boost the labor market versus the other side, who see a still growing economy and inflation far above target, arguing for a pause. So I'm very happy to welcome back to Central Bank Central David Kotok, a decades-long Fed watcher, watching its policy so closely and analyzing and its impact on markets broadly and on the municipal bond market in particular. David co-founded Cumberland Advisors in 1973, and during his career there served as Chief Investment Officer, CEO, and Board Chairman. He's co-authored 5 books, or authored in particular, The Fed and the Flu, which was published earlier this year. The title, Parsing Pandemic Economic Shocks. It's quite a work of history, and a lot of work went into it. David has served as program director and as a director of the Global Interdependence Center for many years and worked closely with its College of Central Bankers. David, it's great to have you back on Central Banks Central, especially at a time when there's this deep split on the Fed, conflicting signals on the economy as well, at a time when government data has been limited and traders and investors are clamoring for more cuts. So let's just start with the big picture. What do you see? What is going to happen? You're looking for a rate cut and maybe signals for more rate cuts next year?
Well, thank you, Kathleen. It is always, 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 always a pleasure over many, many
Many
years.
years.
You haven't changed a bit, but I've gotten a little older. Um, this meeting is a foregone conclusion about what's going to happen. They're going to cut a quarter point. There's going to be division. We've already seen it. It's been discussed repeatedly, and we face a change in the chairmanship, and we know how that's evolving. We know there is a likely successor, but nothing is final until it's final. And final means there's a few months ahead that have to expire and time has to run its course. So one has to say, gosh, we have a range of views within the FOMC. We see the division in views, as you just articulated, and we have some expectations of one or two additional cuts sometime next year. And I would like to add the word maybe.
Hmm.
Market expectations that are pricing a cut this week are pretty clearly established. Something that is trying to project what the Fed is going to do next June is guesswork,
Yeah.
pure guesswork. You want to spend a lot of time and energy talking about it, have at it. It makes no difference today. What makes a difference today is to look at the conflicting forces at work in the world, which are difficult to grasp. Why difficult to grasp? Because we have shocks taking place in policy. We have no growth in the labor force for the first time in almost a century. If you have no growth in the labor force and you want to grow at a certain rate economically, you need to have total factor productivity close the entire gap because you don't have a labor force to help you do it, or labor force growth to help you do
Mhm.
it. So what do we have today? We have a circumstance in which we're trying to project and guess at economic growth with a wounded wing, a broken wing bird. How do you fly that
Yeah.
one?
Yeah. Well, but of course, David, there are signs the economy is still growing, and I think that's one of the things that is difficult. We had a shortage of data, but latest jobless claims look just fine. Maybe they were lower than you might have thought. Maybe a little bit exaggerated by Thanksgiving, but it doesn't look like layoffs are still low, but even the growth in the economy, people are still spending money. Bifurcated maybe, right? Lower income, not as much. Middle to upper income, spending is fine. So I think that's another thing that makes it very difficult because in order to justify another rate cut with inflation at 3%, right?
That's
And
right.
the funds rate already below 4%. Michigan, if you take one of the more a very closely watched survey of inflation expectations, and you look at 5 years ahead, they're looking for it's a 4% in that survey, right? So it
W-
seems that this is the tough thing. Markets want to see more cuts. There's no doubt about that. But what's the economy telling us? What is inflation telling us?
Well, you describe it perfectly. If inflation is 3% and we are accepting of the fact, now we could debate 2.9, 3.1, depending which measure you use. There's 20 ways to come up with an estimate of some type of broad inflation number, but 3% is a good number. And if it's 3% and trending higher, not lower, and the outlook of the forces to unfold, best guess we have today is that 3% is going to go higher. Why cut an interest rate when, as you said, the economy, given the shock on the employment, the labor force, is doing okay? What is the effect of monetary policy when the economy is doing okay and the inflation rate after 5 years of effort is 100 basis points ahead of your target, above your target, and trending higher? What do you expect monetary easing to do? Fuel
Mhm.
more inflation or restrain more inflation? Most people would fall in line and say, under those conditions, you're going to fuel inflation. And what are you going to then do? Set yourself up to have to slam the economy hard because inflation is not three, it's 3.5, or it's four. And that's a real possibility coming at us within the next year or so. So uh, we face an extraordinary circumstance in the central banking arena, in the policymaker arena. We just had this huge discussion in New York last week about policymaking in this framework and the College of Central Bankers. I thought that symposium had a lot of power. And the end result is there is no result because because decisions are being made with political forces
Hmm. Okay.
influencing them. And there's a big division. We don't have a consensus format now.
Right. Well,
That's missing. We're so used to it.
well, there's a very old-fashioned view, but sort of a long-term view, that the one thing a central bank can control is inflation, and price stability is its most important goal. And at that, Global Independence Center College of Central Bankers symposium, that was expressed more in depth or less in depth by a number of people. And I think that's what also causes some people to scratch their heads, right? And I assume, including you, because if you look at the markets. Maybe we're starting to see that long end get a little more upward pressure on the yields, but the short end still accepting, short-term yields, accepting, oh boy, they're going to keep cutting rates. And ultimately, you're going to steepen the yield curve and possibly even more as Japan's government bond yields keep rising, right? It's a world that if I were a bond guy like you, I mean, should I be concerned? What should I be watching? Where should I be putting my money?
Well, you have to now make choices, especially in the bond world, where credit spreads are so tight. And because the economy looks like it's doing okay and is not encountering a liquidity crunch, or we haven't seen any shock. The last shock we saw was Silicon Valley Bank. So we haven't seen any shock. And what have we seen? We've seen the Fed stop quantitative easing. Correction, quantitative tightening. We've seen the Fed stop quantitative tightening. Well, okay. What's the right size of the Fed's balance sheet? I don't think anybody knows, and it's a changing number. And when you now look at what has to transpire with the tariff money, what if Scott Bessent has to return 200 billion immediately to the party that the custom agent collected the remittance from? What's he going to do? Supreme Court says, real quick, the Supreme Court says, you got to pay back 200 billion. You got to pay it
Okay.
back with interest under federal law, just like any other tax refund. And Scott Bessent is going to do the following thing. He's going to use a Treasury general account, which is sitting at the Fed, and he's going to send 200 billion back to the people who paid him. Now,
Mm-hmm.
let's examine that for a minute. I might be a transfer agent, and the goods might have come from a manufacturer in one country and headed for Walmart in another country. And in between, there was transportation and there was
Okay.
finance, and you had 10 parties in this deal. But
Okay.
I'm the one that had to write the check to the custom agent or
Okay.
wire the funds.
Because
I get
you're
the
going to get the money.
I'm going to
You're
get the
saying,
money,
yeah,
and I
correct.
might have 1% invested in the transaction. Is Walmart going to say to me, hey, you got the money, give us our share back? We had to take a price
Right.
action. Is the manufacturer going to say, I cut my price because of Trump's tariffs to absorb the shock, and you can't keep my money? I'm the one who took the hit. A
Okay.
200 billion fight. While the fight takes place, what is the financial transaction? 200 billion moves from the Treasury general account at the Fed into bank reserves overnight. That's a fiscal stimulus shot of $200 billion right
Okay.
there in cash.
So another reason maybe not to be so eager to cut rates?
Well, you're cutting the interest rate at the same time. You have a fiscal injection of 200 billion. In
Mm-hmm.
some places, 200 billion is still real money. I'm not sure anymore everywhere, but some places.
Well, so speaking of the administration, and the administration has said it's going to stop net new issuance pretty much of longer term securities, and that goes
Yeah.
along with the end of contract. Okay, and it's going to be funding increases in the fiscal deficit with treasury bills, the shortest term thing you can get. So, what is that going to do to financial markets now? Again, you're an investment guy. What do you see here?
Well, we talked about this in New York. I thought Dennis Lockhart's comment on the stage about his role in PayPal and how he sees stable a dollar linked stablecoin and how a token, which is what it is a form of dollar payment that is expanding worldwide, and how the pool of funds to secure that consists of treasury bills was fascinating, because what Dennis did is say, everybody who thinks the world's going to come to an end, the dollar debasement trade is going to go on, and all of that has to contend with a rising use of the dollar, treasury bills, in a larger and larger and larger pool as the collateral for a payment mechanism which is expanding worldwide.
Okay.
And maybe we're going to have dollar strength. Maybe we're going to have demand for treasury bills in the trillions. And maybe the federal government will be supplying those trillions in a deficit where we all wring our hands about the deficit long term. And I agree with that. But in the short run, we may not have such a crisis.
Hmm.
We
Well,
have a new source of demand for T bills, and it's the pool that is securing the stable coin
okay,
linked to
yeah.
the dollar.
Yeah, well, and of course there are some questions here. Ken Rogoff wrote a big paper for the Group of 30 about stable coins, and he does see some risks and he does see some things that have to be regulated. So it's there and it's growing, and I think that's the question of where it goes. But we know for sure that there there's a is there some kind of regime change happening? We know that people are looking, some are looking for the economy to slow, and we need more cuts. Other people are looking for stubborn and rising inflation. Well, first of all, before I get to the shift, the regime shift potential, which do you see? Do you see this economy slowing? Do you think that that's really and truly what's happening, that and it really necessitates more cuts? uh for the Fed, or do you think the inflation is the problem? What, come on, David Kotok,
If
what
I
you
was
see?
sitting on the FOMC in this meeting and I had no constraints on me and felt none, I would not vote for a cut because the unknowns are huge. The inflation rate is above the target. We can have an explanation for the employment labor force changes. Why cut? For what? To make somebody happy because they want to have interest rates go down? That's not your job if you're in the straight and narrow role of the Fed. And you said it well. What's the Fed's job? Attempt to reach price stability that's become defined as roughly 2%. And I would say maintain financial stability so you don't have a
Yes.
shock like a Silicon Valley bank. That's the Fed's job. All the other things got piled on, expanded, contracted. It's a debate. We could have the debate for hours. It doesn't matter. What matters
Right.
is keep the inflation rate low. It's not happening. And keep financial stability so we don't want to have a crisis. We don't want to have banks fail. We don't want to have payments fail. We want a system that we don't have
Right.
to think about.
Well,
That's what
there's a
the
lot of concern,
Fed's
right?
job should
And of
be.
course, the big surrounding question, and this was certainly discussed in from many different angles last week in terms of the GIC and the College of Central Bankers. Um, you've got what change is going to come via the White House, right? Trump wants to control the FOMC, control the Federal Reserve Board, control the appointment of Fed district bank presidents. Do you think that he and his team are going to succeed at that?
Well, they are working at it. That's clear. They have a directional trend. That's clear. We have the evidence of the first confirmed governor appointment. That's clear. What happens to that seat in a short period of time, and does Myron stay or not? I mean, does he get replaced? Does Powell leave when he's no longer chair and give up the seat for an appointment? I mean, there's a lot of moving parts, so we don't know for sure. We can speculate about them, but we do know there's a pattern. Donald Trump made money during his career with two things: inflation of real estate values, big time and repeatedly, and disdain for repayment of debt. You look at his history and how many bankruptcies come from his enterprises. I remember them from the days of the casino operations. Remember, I was chair of the casino authority in Atlantic City. I dealt with Trump. I negotiated with him personally for 2 hours in a room over a payment structure. It was a little building called the Taj Mahal.
Remember
By
that,
the way,
yeah.
the building's been torn down, and 6 months after our negotiation, he never paid the 15 or 20 million that he owed the state of New Jersey. So if you look at his history, he's benefited from inflation, and he soft talks about it. He's benefited from the use of debt in structures where he didn't repay the debt. Why is he any different now than he was? In the course of his career, he has even mentioned defaulting by the US. He has mentioned driving interest rates to 0 or 1%.
Okay.
And if he has 4 cheeseburgers and indigestion at 2 o'clock in the morning, out will
Well,
come a screed about
yeah.
the Fed and the interest rate needs to be
Well,
0.
well, then how come then you must be pretty concerned about bonds. Come on, if that's where you see him going and you see things potentially heading, you must be concerned about bonds. What kind of
I,
bonds would you buy or sell or
I am concerned about certain bonds, and there are other bonds which I think are very cheap. And the cheapness is found in the better grade tax-free municipal bond. Now, somebody say, okay, Kotak, you're talking your book. Your company's been doing that for 50 years. Well, number one, there's a bunch of young people who are running the company. I'm an old curmudgeon troublemaker at Cumberland Advisors. But if you look at the mechanism today and you say, what am I going to do? Am I going to put money in the stock market? Well, it's averaged 8% over the last 100 years or whatever, but that's a lot of volatility. And we're coming off 3 great years. It's been wonderful. If I can put my money to work tax free between 4.5 or 4, between 4 and 5%, closer to 5 or 4 3/4, and I can earn off of a very high grade tax-free bond roughly the same interest rate as a 30-year US Treasury bond, which is taxable. To me, that becomes a no-brainer if I'm an individual. Now, if I'm a philanthropic institution, tax-free bonds mean nothing to me. But if I'm a family office accumulating wealth and I'm in the upper spike of the K, not the down spike, those folks are suffering. But I'm in
Mhm.
the upper spike. And Donald Trump has just rewarded me for being where I am. I didn't do anything to earn it by cutting
Okay.
my taxes next year. And I'm going to have Kotok, David Kotok's going to have more cash by thousands of dollars because I got a tax cut. I didn't deserve a tax cut. I
Okay.
didn't ask for it. What am I going to do with that cash, Kathleen?
Put it
I'm
into
going to,
tax-free municipals.
exactly, because I can do a risk adjusted return at roughly 7 or 8%, depending on what state I'm
Yeah.
in and what the local taxes are. And I can look at the stock market and say, gee, if I look at the stock market today for the next 20 years, my expectation at best is 7 or 8%. Now
Right.
I've
Yeah.
had, you
Okay.
don't get 20% every year. And if I look at real estate and I say, gee, there's some problems. Real estate's good in some places, and other places it's got problems. So I like the tax. Now, am I
Okay.
talking my book? Yes.
Yeah.
What am I doing in my personal account? I have a overweight position in high grade tax-free municipal bonds,
Okay.
and I don't have to look at them every day. I don't have to, they sleep by
Okay.
themselves. I
Okay.
don't
Well,
need to look at the VIX
there you go. Okay.
every
Well, look.
morning.
Well, and I'm going to say because when it was introduced to me, I forgot to tell people about the Kotok report on Substack because David writes about
Thank
all
you.
kinds of things, and I'm sure you're going to get so many things covered, but including this kind of analysis because this is what you've done for so long. So, a final question, and I just want to mention you mentioned Dennis Lockhart. Dennis Lockhart, of course, former president of the Federal Reserve Bank of Atlanta, and so in terms of if what if the administration does get control of the Fed more and more? Maybe not completely, right? But if they get Kevin Hassett, who's a Trump loyalist, in, and they manage to change things so that they can get rid of people on the board who are been there for a long time, who might then be more in the Trump camp. What's that going to mean for international markets and the dollar? Because ultimately, that's not the main thing you invest in. It's not the main thing that drives things, but it's a big, big factor. And I think it's one that central bankers around the world are watching oh so closely.
There's no question they are. We talked about it in New York in the closed sessions, Chatham House sessions, and in the public forum. And that is a big overhang. It's the gorilla that hangs around in the room, if you will. The issue becomes trust in the United States and in the central bank of the United States. And a point in the discussions was there is an asymmetry with trust and confidence. If I have trust and confidence, I'm in one place. If you rattle my trust, if you reduce my confidence, it takes a long time to get it back. And that has happened in the last year. So
Well,
the global force that determines asset allocation into the US or elsewhere is dealing with the
but
asymmetrical
true,
shock.
true, true. But isn't it true also that Dennis Lockhart and another one of the people, Catherine Mann, and this is not the off the record. This is the on the record portion of this conference. Who was talking about? They were talking about sterling and the dollar, and Kathy Mann talked about how sterling was once a king currency and came
Yes.
down. U.S. still a king currency and has been for a while, but neither one of them said they expect any that they don't see any big decline in the dollar right now, or even particularly much of one, or necessarily that there is a big threat. And I guess this is my final question again as an investor. Yes, maybe it's been a loss. Maybe people are wondering about Trump and what happens next. That's what we're talking about. However, so far it looks like dollar is still holding pretty steady. Where are you going to go, renminbi? Probably not right away. So it seems that that was sort of one of the main views discussed.
Well, I had conversations with Kathy Mann and with Dennis on this very subject, and they were public in the forum, so I can talk about them. And the fact is, whether you want to call the dollar the worst, least worst,
Yeah.
or the best is irrelevant when it emerges as the selection relative to the others. And as Kathy Mann pointed out, it took 20 years of erosion for sterling to finally reach its demise as the reserve currency. And if you look at the Shanghai operation as a payments alternative to the dollar, it's true. It's got 30 countries, many of them bad actors, involved in a new type of
Right.
payment system, and the players who are in both Swift and the Western world and Shanghai, and there are players in both camps. And what are they doing? They're arbitraging in them. So
Okay.
I don't think the dollar is dead today. I think the dollar is going to be here for a long time. I agree with Dennis and Catherine Mann. Everybody likes to say the world's coming to an end. It makes a headline. The
Okay.
debasement trade makes a headline, and the gold price may go a lot higher, driven by demand for
Right.
various reasons. But the dollar's not going away,
Okay. Okay.
in my opinion, anyway. I like George Washington and I like Ben Franklin, and
Yeah,
they're
me
going to
too.
be around.
Okay. All right, David Kotok, and you too. So, David Kotok, thanks so much. As always, a fun and interesting conversation at a time where there's so much to talk about. And I just would like to remind people, let's close with that. Remind people of the Kotok report on Substack, all kinds of topics, easy to find, writing just all the time, almost every day. So let's see what happens now with the Fed, and we'll talk about that again soon.
Thanks so much, Kathleen. It's nice to be with you.
And it's nice for everybody to join us today on Central Bank Central. I'm Kathleen Hays.